It's called Tortoise Midstream Energy Fund. The ticker is NTG. This is a pipeline, it's a closed-end fund that owns pipeline companies. Now, why do we like pipeline companies? Well, first off, they are in extremely high demand right now. A pipeline company gets paid not on the price of oil, although when oil prices are higher, they tend to run more full. They get paid on, so here's margin of safety, we talked about that. Tortoise Midstream Energy Fund, they get paid, they're a toll taker. They get paid the volume of energy that flows through their pipelines. This is an extremely resilient business. Over time, in fairness, when these first were getting set up as companies, as separate companies from some of the oil conglomerates that owned them, they were involved more in growth than in gushing cash flow. Now these are gushing cash flow businesses. These are NIMBY businesses. People don't want to see a pipeline built for political reasons or whatever. But the good news is when you own a pipeline, even if another pipeline is being built, it's going to be somewhere else. So these things are great, resilient, sturdy businesses. Now we like all sorts of pipeline companies. Kinder Morgan is an example. For example, if you like one individually, we like NTG better. Why? Well, it owns 25 different assets, so it's diversified. It has a better yield than most, 8.6% distribution rate. The next point is big for many investors. No K1, so they own master limited partnerships, but because the closed-end fund owns it, and you own the closed-end fund. If you own NTG, you don't have to worry about the tax considerations and complications of owning a K1 or a master limited partnership. So that's a huge benefit. The way we think about NTG is there's a double margin of safety. If we could buy all these assets at par, they're already cheaper than where we think their intrinsic value is. And then on top of that, there is more than a 15% discount to net asset value within Tortoise Midstream Energy Fund. So we love it. We think that discount will continue to close. In fact, it has closed. We were buying it at a 20% discount. It's now closer to a 15% discount. The portfolio managers of their fund agree with us. They have now put out a tender offer for 5% of the shares outstanding at a 2% discount. So that's only 2%, or that's only 5% of the shares outstanding. But if you're buying this now, you could some amount of your shares will get tendered, and you'll collect that for just hanging out. So you're welcome. Hopefully this will pay for the cost of the conference. We think that the fund managers will continue to do this. We like finding things like this. We're involved in other closed-end funds that trade at material discounts to net asset value, where we like the underlying value. We like double dipping into a margin of safety investment.